Hi, my name is MC Laubscher. I'm the Chief Cash Flow Engineer at Producers Wealth. At Producers Wealth, we help business owners and investors create their own banking system. The first thing that we need to do as business owners and investors is to find a vehicle which we can position as the keystone, the bank within our own banking system. Now, where is the best place for producers like business owners and investors to warehouse their capital? It is, of course, a place where they can easily access their capital to grow their business and their investment portfolio. I like to call this vehicle the Producer's Capital Account. And in this presentation, I'm going to share with you why the Producer's Capital Account is the vehicle of choice for banks, corporations, family offices, and wealthy individuals to warehouse their capital. First, I'll share with you the strategy which we help our clients at Producers Wealth implement and execute. We call the strategy the Aligned Capital Strategy. Essentially, there are 5 parts. In the first area, we have to create capital. Capital creation is when we generate capital either as an employee, a self-employed person, a business owner, or an investor. After we've generated capital, we have to place and position that capital somewhere. We call this capital capture. How do we efficiently and effectively position capital so that it does multiple things for us within our own personal business and investing economy? As I will share in this presentation, this is the foundational piece of our own banking system, and this is where we will build our own banking system from. After we've positioned capital effectively and efficiently, we then deploy that capital to generate income and cash flow from assets. These are assets that pay us to hold them and to own them. We can also position capital in areas of growth, in markets and in market segments and niches where there is incredible upside potential because there is capital flows into those markets, those market segments, and those market niches. And once we have created capital, we've positioned that capital as effectively and as efficiently as possible. We've deployed that capital and investing in assets that pay us to hold them and to own them as investors. And we've also positioned capital in areas where there is significant upside potential in markets, market segments, and in market niches where capital is flowing to. We then have to protect this capital that we've created, that we've positioned, that we've deployed, and that we position for growth through proper tax strategy, through proper asset protection strategy, and through proper estate planning. This is the Aligned Capital Strategy, which all of our cash flow engineers at Producers Wealth help our clients implement and execute. This is the blueprint of what we do. So let's start off big picture by zooming out and looking at our economy as a whole. And inside of our economy, you will notice that there is essentially 3 different economic realities, 3 different economic characters. So who are they? The first group of characters are borrowers. The second group of characters are rat racers. And the third group of characters are producers. So who are they and how do they operate? Well, borrowers is the first economic character. And in this economic reality, we have individuals that have not established good financial habits and do not have any savings, and they don't have any infrastructure within their personal business and investing economy to generate savings. So they have to borrow capital to purchase consumer goods such as vehicles, houses, and also they have to borrow money for education and their children's education, and then they have to borrow money for liabilities. Now, the borrowers is essentially on the wrong side of a compound interest equation because they don't have any good financial habits and good savings habits, they will always need to borrow money from banking and financial institutions. Now, the second group of characters are the rat racers. Now, the rat racers do have some good financial habits and they do have savings habits. So what rat racers do is they essentially save some capital. And when they have enough capital, then they essentially draw down that capital to purchase consumer goods and items such as vehicles and houses. And then they have to start the process over again and build up their savings to eventually pay for the education of their children, which will then draw down and deplete their savings again. And then they have to build up savings again over time so that they can eventually buy liabilities which they can enjoy recreationally. The reason why they're called rat racers is, as you can see, they're essentially in a game where they put away savings, they build up savings, and they draw down to almost zero, and they start all over again. Rat racers essentially experience Groundhog Day every couple of years. The third group of characters are producers, and Producers Wealth was built for producers. Producers implement and execute the strategies of the 0.01%. Producers have incredible financial habits. They have a very high financial IQ. They have great savings habits, and they pay themselves first. Their savings rate is 10% at a minimum, and our top producers save as much as 40% of their income. And by top producers, I mean our top clients at Producers Wealth. So what do producers do? Producers put their capital, their savings, in a vehicle which has it accumulate. And when it reaches a certain level, they can then use that vehicle and place that vehicle and their savings as collateral for a line of credit. Once they get a line of credit secured by their savings, they use the funds from that line of credit to acquire other assets that pays them to hold and own and invest in them, such as businesses and real estate. As you can see, producers are on the right side of a compound interest equation because they have essentially uninterrupted compounding in their savings vehicle, which they use as collateral for a line of credit, which they then access the fund through the line of credit to then use and leverage it to invest in more businesses, more real estate, and other assets that pays them to hold and own them. Why do producers accumulate capital in a savings vehicle and then they use that vehicle and the savings inside that vehicle as collateral for a line of credit to acquire more assets? Well, it plays into compounding interest and uninterrupted compounding interest versus amortizing interest. So let's take a look at this example. In the economic reality of our characters, the borrowers, they would go and borrow $50,000 at 6% interest, and the repayment period is 25 years. And in that example, it's going to take them about $161 per month to repay that $50,000 that they had borrowed at 6% interest. Over 25 years, the borrowers, through amortizing interest, would have paid $46,645 in interest. Now, let's take a look at compounding interest and uninterrupted compounding interest. So let's just say the producers placed $50,000 into savings and they earned 6% interest for the period of 25 years. Well, they would have earned $164,593 in interest, which will bring their final balance between their initial investment of $50,000 plus the interest of $164,593 to a final balance of $214,593. Do you now see the two different realities between the borrowers and the producers? Do you see the different realities of uninterrupted compounding interest versus amortizing interest. Do you see the two different realities of economic characters that are on the right side of a compound interest equation, like the producers, versus the economic realities of the characters, such as the borrowers, which is on the wrong side of a compound interest equation? So as you can see, it's a pretty powerful strategy to save and accumulate capital in a savings vehicle, which is an asset, and then use that savings vehicle as collateral for a line of credit, which you then can use to acquire other assets. So let's take a look at collateral and what collateral is and how you can implement and execute a similar strategy within your own personal business and investment economy. Collateral is simply an asset a lender accepts as a security for a loan. What is collateralization? It's essentially the process of using one asset to acquire another asset. People are familiar with utilizing a collateralization strategy. It's just not called that generally. Well, let's take a look at some assets that banks and financial institutions will accept as collateral. Most people are familiar with real estate. When you own a property and you've built up equity in that property, you can go to a bank or a financial institution and get a line of credit that is secured by the equity that has been built up in this specific property. It's known as a home equity line of credit or a HELOC. Businesses can also be used as collateral. A person in my network used the assets of his business as collateral to secure a business loan. He then used the business loan to buy the real estate from which the business operated. So he used his business, placed the assets of the business as collateral for a loan, and then he used the loan to buy the real estate. He used his business to buy the real estate. Stocks can also be used as collateral with banking and financial institutions. A specific stock or a specific stock portfolio can be placed as collateral, and you can then get a loan that's secured by that specific stock or that stock portfolio. Elon Musk, the founder of Tesla, of SpaceX, the Boring Company, and Neuralink, is currently in the process of buying Twitter. And one of the strategies which he's exploring at the time of recording in which way to buy Twitter is actually to use some of his Tesla shares as collateral to get a line of credit, using his Tesla shares and then using that line of credit as financing for the Twitter deal. You can also go to a bank and you can put money in a certificate of deposit. And the chances are very good that that same bank will then give you a loan secured by the certificate of deposit, which you opened with the bank. You can also use gold, silver, and art and place gold, silver, and art as collateral with certain banking and financial institutions and certain custodians, and they will give you a line of credit which is secured by the value of your gold, silver, and your art. You can also use cryptocurrencies as collateral. There are certain banking and financial institutions which will allow you to place your Bitcoin as collateral to then get a line of credit or a loan which is secured by your Bitcoin holdings. And then, of course, life insurance, and more specifically, a dividend-paying whole life insurance policy with a mutual insurance company. This is my favorite asset to collateralize and leverage using a line of credit. And this is also the preferred vehicle for banking and financial institutions, corporations, family offices, and ultra wealthy individuals. And in this presentation, I'm going to share with you why it is their vehicle of choice in establishing their own banking system. So why is life insurance called the producer's capital account? And more specifically, why is a dividend-paying whole life insurance policy with a mutual insurance company structured specifically for high cash value life insurance the keystone in our banking system? In the beginning of this presentation, I shared the best place for business owners and investors, which we call producers, to warehouse their capital is a vehicle in which they can access that capital to grow their own businesses and also grow their own investment portfolios. So when you structure a high cash value life insurance vehicle, you're going to make deposits in those vehicles, also known as premiums. And the majority of these premiums, about 70% or more, is going to go straight to the savings element of this policy, and also known as cash value. Your original cash value is your principal, and your principal is guaranteed in these policies. It'll never go down in value. The growth is also guaranteed in these policies. And because these policies are structured with a mutual insurance company, you are, as a policyholder, a shareholder in the mutual insurance company, and you get to participate in dividends that are distributed when these companies are profitable. These companies have an incredible track record of profitability. One of our favorite carriers have been around since the mid-1800s, and they have paid dividends every single year since the mid-1800s. Premiums of life insurance policies are paid with after-tax money, and it's not deducted from taxes, and therefore the growth in these policies and the growth that the dividends contribute to are tax-free. You can also access the funds tax-free in these policies through a line of credit. And you can also take distributions from these policies through specific strategies tax-free. You can also add disability riders to these policies, would be activated if you cannot produce and create in the capacity which you're currently producing and creating. And the life insurance carrier would then essentially pay the insurance in the policy to make sure that the policy doesn't lapse. There's also a tax-free death benefit paid, usually a multiple of the cash value, to the beneficiaries of the insured person. This could be a spouse, family members, or a family trust. These policies also enjoy asset protection, and they are private contracts. And of course, these policies provide incredible continuity for families and for businesses. So let's compare the producer's capital account, a dividend-paying whole life insurance policy with a mutual insurance company structured specifically for cash value, with other assets to use in establishing a line of credit. So let's look at the vehicles that provide a guarantee of the principal, which is placed in the vehicle, and also a guarantee on growth. As you can see, the life insurance has a guarantee of its principal and a guarantee on growth, where gold, silver, and art does not, crypto does not, and stocks do not. What of these assets and vehicles provide a tax-free growth opportunity? Well, life insurance does. Gold, silver, and art does not. Crypto does not, and stocks do not. Can you access liquidity tax-free? Well, with life insurance, you can. With gold and silver and art, you can. And with crypto, you can as well. And with stocks, you can. What percentage of the value of the asset can be accessed through a credit line? With life insurance, it's 90% or more. With gold, silver, and art, it's usually 50% of the value of the gold, silver, and art. With crypto, it's about 50% of the value of your crypto. And with stocks, it's about 50% of the value of your stocks. What of these assets provide tax-free distribution? Well, you can see that the life insurance does provide tax-free distribution through very specific strategies. Gold, silver, and art, no. If you sell it, there's going to be capital gains. Crypto, if you sell it, there's going to be capital gains. And stocks, if you sell the stocks, there's going to be capital gains. How about a death benefit? What of these assets and vehicles provide a death benefit? Well, with life insurance, we know that it does provide a death benefit which goes tax-free to your beneficiaries, whether it be a spouse, family members, or a trust. Gold, silver, and art does not produce a death benefit. Crypto does not produce a death benefit, and stocks do not produce a death benefit. So let's compare the producer's capital account, or more specifically, a dividend-paying whole life insurance policy with a mutual insurance company structured specifically for high cash value with other savings vehicles. As you can see, life insurance offers tax-deferred growth, tax-free distribution, a competitive return, which is also tax-free. It also offers high contributions, additional benefits, collateral opportunities, a safe harbor, a protection and guaranteed of principal, also known as no loss provisions. You also have guaranteed loan options, unstructured loan payments, and you have access to liquidity, which you can use and control at all times. The only thing that the life insurance vehicle does not offer is tax-deductible contributions. So how do we use the producer's capital account within our own personal business and investing economy and within our own banking system? As you can see, we make deposits into a high cash value life insurance policy where the principal is guaranteed. There's also guaranteed growth, and we earn dividends, which is essentially participating in the profitability of the life insurance carrier. We then establish a line of credit secured by our cash value in the policy, and then we use the funds of the credit line to invest in our business or in other assets such as real estate that produces cash flow, and the cash flow is then used to pay down the credit line. So how does the producer's capital account give producers the producer's advantage? Well, you enjoy uninterrupted compounding in your producer's capital account because you never access the capital inside of the account. You establish lines of credit which is secured by the capital that has been accumulated inside of the producer's capital account. You also protect your capital from one of the biggest destroyers of capital, taxes. You pay taxes when you have control over them and when you know how much you legally owe in taxes. Once the capital has been put into these accounts, you're going to enjoy tax-free growth. You'll be able to access the liquidity tax-free through establishing lines of credit, and you'll also be able to take, through very specific strategies, tax-free distributions when you need to. Having a producer's capital account is going to help you capitalize on opportunities because you'll always have access to capital. It's going to enable you to benefit from inflation by having your capital not only work harder, but smarter in many different areas in your own personal business and investing economy. And of course, you're going to avoid losses by having your producer's capital account because the principal is guaranteed, the growth is guaranteed, and you're going to enjoy the benefits of dividends, which is essentially sharing in the profits of a mutual insurance company. You're also never going to draw down the savings which has been accumulated in the producer's capital account because you're going to access capital through setting up and utilizing lines of credit. And this is why you're enjoying the uninterrupted compounding interest, and you are on the right side of a compound interest equation with your producer's capital account. So how do I make sure that these life insurance policies, these dividend-paying whole life insurance policies with a mutual insurance company that is specifically designed as a high cash value life insurance policy, how do I make sure that this is designed correctly, or this is designed in a way that I can use it as the keystone for my own banking system? Well, the first thing is it has to be designed to provide flexibility of funding. There has to be flexibility of funding. You should have a minimum and a maximum contribution in your policy. There also should be a catch-up provision so that if there is a year where you don't fully maximize and fund the policy to the full amount that you could, your maximum amount, you should be able to go back and catch up contributions in the previous year. You also should be able to establish a line of credit with these policies within the first 30 days. There should be no fees to establish a line of credit. There should also be no required interest payment on the line of credit. There should be flexibility of payments. And there should be other provisions in the policy, like a disability rider. As I've shared before, when these policies are designed correctly, about 30% of the premiums should be going towards the life insurance portion, and about 70% of the premiums should be going towards cash value. And that's the portion that can be utilized as a credit line. And you should be able to do this in approximately 30 days from setting up your policy. So what does one of these policies look like? Here's an example of a male that is age 40. And in this example, this male funded his policy in year one with $100,000. And then from year two to age 70, he's going to fund it $50,000 per year. As you can see, with the values at the end of year one, he would have had close to 80% already of the amount that he's put into premiums available in cash value. The column total net cash value is the column which can be used in establishing a credit line. And as I've mentioned, 90 to 95% of the total net cash value can be accessed through a line of credit that is set up properly. As you can also see in the first couple of years, there is a buildup in the policy. And then eventually by year 7, the policy capitalizes and there's more capital available in total net cash value than the premiums that have been contributed to the policy. In 10 years, he would have put in $550,000 in premiums, and he has $629,079 in cash value. It becomes pretty powerful, as you can see, the longer he has this policy. In year 15, for example, he would have put in $800,000 in premiums, and he has over $1 million tax-free in his policy available that could be used to establish and set up a line of credit. In year 15, you can also see, while he still just only put in $50,000 that year, the policy value grew by over $100,000. So he had some very, very good growth in his policy that year. At age 65, he would have put in $1.3 million, and there's $2.3 million tax-free with a death benefit of $4.79 million that would be paid out tax-free to his beneficiary, whether it be a spouse, family members, or a trust. At age 70, he made his final payment of $50,000, and you can see a total of $1.55 million went into the policy, and he has approximately $3.325 million tax-free in this policy with a death benefit of $5.49 million in death benefit. He will also be able to take income from this policy through specific strategies from age 71 to 90 of $237,982 tax-free. So he's able to take income, sort of his own quote-unquote private pension that he has established here, because he'll be able to take tax-free income of $237,982 from age 71 to age 90. There are a lot of producers that have reached out to us between the ages of 55 and 70, And they've reached out to us because they've either had a windfall through an inheritance, a sale of a business or a property, or they're 59 and a half and they're looking to move capital out of qualified plans into the producer's capital account to essentially protect their retirement savings and set up a tax-free retirement for themselves. So here's an example of a male that's age 60 that had $1 million that he needed to move into a vehicle where his savings are protected, and also that he could essentially use to set up a tax-free retirement for himself. So what we did is we took the $1 million and we paid it into the producer's capital account for 5 years. And after 5 years, as you can see, there's no more premium outlay required. There's no more out-of-pocket cost for this person. $1 million went in. And by year 6, as you can see, there's over $1 million available in cash value with a death benefit. He was, of course, able to set up a line of credit secured by his cash value after 30 days of setting up this policy. So he would be able to access liquidity for emergencies or if there's any other assets that he wanted to acquire while he was repositioning his savings. Here's an example of a 60-year-old male that wanted to reposition capital from a qualified retirement plan into the producer's capital account so that they can protect their savings and set up a tax-free retirement for themselves. As you can see, we took $1 million over the course of 5 years from a qualified retirement account. When the money came out of the qualified retirement account, taxes are due on the funds that are withdrawn from the qualified retirement account. Once the money was put into this vehicle, then it can grow tax-free. As you can see in this example, this person is taking a tax-free retirement income after repositioning $1 million over 5 years of $62,561 from the age of 66 to the age of 90. Here's another example of a male that's 40 years old that is funding the policy $50,000 per year in premium up until age 70. Now, what does that look like? Again, we can see that close to 75% in year one of the premiums went straight to cash value. And we could see that there was a buildup. And then in year 7, the policy capitalized. There's more capital available in cash value than premiums paid into the policy. In 10 years, there was $500,000 of premiums paid into the policy, and there is a cash value of $581,909. And we could also see again that by year 16 and age 56, while he only paid in $50,000 in premiums that year, the growth in the policy was over $101,984. Of course, at age 65, there's $1.24 million of premium paid into this policy, and there is $2.3 million tax-free available in cash value. At age 70, there was $1.495 million of premiums paid into this policy, and the total net cash value is $3.227 million tax-free, with a death benefit of $5.17 million. This person was able to take a tax-free retirement from age 71 to age 90 of $230,837. This slide shows you the power of thinking multi-generational, and this is essentially one of the biggest secrets of the wealthiest families in the United States and in the world. They understand uninterrupted compound interest. In this diagram, we look at 3 generations of proper planning. Now, we assume that the parents would have children at age 30, and the following generations would have children at age 30 as well. Using those assumptions in this model, we can share with you and show you that within 3 generations, one family will enjoy 138 years of compound interest. Just think of the incredible gift that the first generation of this family provided for the rest of this family. We use the producer's capital account in many strategies that we help our clients implement and execute. We can structure and establish a producer's capital account for you to warehouse your emergency savings. We can structure the producer's capital account to be your family's bank. We could also use the producer's capital account as the keystone of your own banking system. You can use the producer's capital account to set up a tax-free retirement for you and your spouse. You could use the producer's capital account to save the tax-free retirement that was promised to you when you purchased a universal life policy. We have saved several universal life policies through a 1035 exchange using the producer's capital account. You could use the producer's capital account to establish a family legacy and multiply the inheritance which you have received. You can also use the producer's capital account as a volatility buffer for retirement. And of course, we have strategies where we show you how to lock in your health through setting up and establishing a convertible term insurance policy, which can be converted to a producer's capital account. If you're interested in exploring how you can maximize your wealth potential, you can start the process with myself and my team at yourcustomstrategy.com, yourcustomstrategy.com. Thank you so much for spending your most valuable resource, your time with me in this presentation. My team and I look forward to helping you fulfill your wealth potential.